Thank you, everybody, for joining. Just want to say hello. My name is Josh Schneps. I'm the publisher of Brownstoner, hosting this webinar today. I want to thank you for your time, and I want to thank sponsors for being here, really to share information for everyone here. It's free information. We want you to ask as many questions as possible. You can use the Q&A function below. You can use the chat function below. We're going to try to get to as many questions as you'll find that we're going to ask a lot of big picture questions and get into some detail as well. So hopefully we're going to be able to address a lot of those for you. I want to thank particularly GR Affinity as well as Corcoran for being here and for being the sponsor. And I think we'll start off by just letting each of our two panelists here introduce themselves, let you know who they are. But I'm really excited to have them because they're experts in their field. They have a lot of knowledge that they're here to share. And why don't we start off, Brian, with you just saying hello.
Yeah, good afternoon. Thanks for joining. I am Brian Scott Cohen. I am a residential mortgage lending officer, I would call myself. I've been in the business. I'm from New York. I live in New York. We lend on residential properties, 1 to 4 family condos, co-ops, townhouses, and excited to be here today and answer questions that you guys have.
Gary, he's really one of the top executives at Corcoran. I'll let him say hello, but thrilled to have you here, Gary.
First of all, thank you for having me. I truly appreciate it. Gary Mallon, Chief Operating Officer of the Corcoran Group. I've been in the business almost 20 years, so I've certainly seen a lot of markets that we've seen the good, we've seen the bad, and I'm certainly interested to talk and hear what everyone has to think about the market today.
Well, thank you both. Again, I just want to emphasize to everybody, you can use that Q&A and chat, people raising their hands, but feel free to use that. We're going to try to make this, honestly, as informative as possible and really as conversational as possible to get down to really what's important. But it's an interesting time in real estate, so it's a great time to be listening and learning. We've seen a big run up in the market, particularly since 2012. The disruption of COVID, which was quite worrying. Some people moved out of the city. Now a lot of people are moving back into the city. Interest rates, obviously, you've seen in the news, are rising. There have been bidding wars, while at the same time inventory is down and prices may be gradually stabilizing. So, Gary, let me start with you. Can you tell us a little bit about what you're seeing out there in the market?
Yeah, I think there's a lot of confusion in the marketplace, concern in the marketplace, and Brian can go into this much more detail than I can, but what it feels like a very extreme run-up in interest rates is definitely having an impact on the market, whether it's from just psychology standpoints or from its actual numbers standpoint. I think that the third quarter happened to have been a very strong third quarter, historically speaking. I think that a lot of people recently have been sort of, I guess, enamored with what 2021 was. I think we always have to put things in context and things in perspective. You couldn't really look at 2020 as a year to judge anything off of for obvious reasons in terms of what COVID did to the marketplace. But then when you see, all the government, free money, for lack of a better way, we're paying the price for now with these incredible rate increases. 2021 was set up to be a very successful year, and it was historical. So you went from one extreme to the other, and now, I would say the first half of it felt pretty strong, still felt pretty good, and then things started to shift. And I think that a lot of people have found the shift to be rather dramatic and rather extreme. I think most people are accustomed to like a slow step off when it comes to pricing, and if there are interest rates. Now I think a lot of people psychologically have felt that we fell off a cliff. So there's more negotiability in the market. We're in that standpoint of market, which always, goes through cycles. The cycle that we're in right now is prices are high, demand is low. We are. And in order to fix that, historically speaking, prices have to come down to get, buyers back into the marketplace. So I think you'll see that, there's been adjustments in pricing, there's been adjustments in negotiability. And I think most buyers at the wrong time, right? Most people always want to sell high and buy low. And the last time I checked, the vast majority of people never time it perfectly. If you do, that's wonderful and great for you. But I think you have to be more realistic about what your personal circumstances are and what's versus just looking at the rate or what the potential price could be. Because if you plan on holding something for at least 5 years, my gut tells you things will ultimately work themselves out, because we've seen the movie before that we're currently living in, and it's always come back. It just quite to come back.
So I'm sure a lot of the people that are on the Zoom right now are interested in buying. And a big question I'm sure a lot of them have are, should I be buying now or should I wait and rent? What's your thought on that, Gary?
It's always a good time to buy, depending upon what your circumstances are. I don't think it's a one-size-fits-all answer. If you want to buy because you plan on living here for less than 5 years and you hope to get appreciation in your home, then I guess my question would be, renting is a better solution for you, because we can't predict where the market's going to be in 6 months today or 12 or 18 months today. And renting is a much more, sort of transactional situation, whereas you do it, you rent it, you're in for a year. And then if you want to leave, what your circumstances are, you can pick up and move on. But I think people always need to say to themselves, like, why am I buying? And what do I hope to get out of this? And if I'm looking at it as my home and a place where I want to live, in a community that I want to be in, values to me, then the price shouldn't always be the sole determining factor. But if you're struggling with the down payment and you're figuring it out, then yes, then maybe the time is to rent and take a sense. But the rental market, as most people know, has been extremely, extremely tight, extraordinarily high. So that's adjusting as well, because things have gotten a little ahead of themselves. So it's a personal / timing decision in many ways.
So Brian, over to you. Interest rates. They've gone up fast. Do you continue to rise, or do you think that they'll pull back?
Yeah, unfortunately, I think we have a little way to go before the pain stops. Rates, Fed is projected to raise rates, and again, Fed rates are different, but it is priced into the market, meaning that there is some correlation, but not directly. So Fed is meeting again November 1st, November 2nd. They are projected to raise rates 0.75 of a point, 0.75. And clearly stating that inflation is still super high, and raising rates is right now their tactic to lower inflation. Hasn't worked yet, maybe for housing a little bit, but not for everything else that the world's going through. So a little further before they start to level off and then hopefully come back down.
Let's talk a little bit about first-time home buyers. It's a huge investment for people. How do you recommend they get started?
Yeah, I mean, believe it or not, with rates going up, well, I would have thought, I'll leave it at me, that the biggest impact would be to the kind of lower or starter home price points, the sub $1 million. Gary and Corcoran and team put out reports every week to give you activity in the market. $1 million sector actually has the largest number of transactions right now. Greater than 50% are all under $1 million. So for the 82 people that are on as participants below, the market's still moving and just getting ready. You start with someone like myself. I think you need to understand the cost of borrowing money. I think a lot of people don't understand what it costs to borrow $500,000 or $1 million or $2 million, and they just hear a rate. It's so high, but I gave you the payment. You may say, you know what, Brian, that's a great payment, actually similar to what I'm paying for rent. So I think the conversation needs to start with the mortgage person to kind of get an evaluation of, hey, what can I qualify realistically? And then once you kind of start there, you'll be what I call armed to go, meet with real estate agents and go out there and find properties.
I guess it's always nice to know what you could afford before you get started, right?
Yeah, not everybody. Sometimes people, unfortunately, sometimes people do it differently or do their own qualifications without a professional. And sure enough, they find a home in their dreams and it doesn't always work out. So definitely want to start with the pre-approval process.
Gary, back at you. Obviously has a big mix of condos and co-ops. What would you say is the better choice in today's market?
Once again, I think it really always comes down to a personal decision. Obviously, from the co-op standpoint, you're trading at a discount to a condo. So depending on your financial circumstances, your comfort of living in a co-op and some of the rules, regulations, application process that comes around that, the inability to truly freely rent it as you might want to. Those things have to factor into your determination when you're making that decision. So if it's purely a price standpoint and you plan on using it as your primary residence, you do not plan on renting it out at any time, absent some extreme circumstance that you didn't anticipate, and you don't mind going through that process, then in many instances, you're going to land up favorable deal, comparatively speaking, but the appreciation might not be as great as a condo. The flexibility might not be as good as a condo. So it's really a matter of going out there and looking in the marketplace. And, it's always interesting what you were talking about with Brian about, it's like, they get very sort of caught up in the news. And to talk to someone like Brian, who understands the market and who understands the type of products that are available. Do you want to do an interest-only loan? Do you want to do an ARM? How long do you plan on living there? There's many ways to sort of play the game. And I think that ultimately speaking, if prices are adjusting and prices are coming down, although it might not feel so great to pay today's price for the apartment because you think it might get a little bit lower, and if I factor in rates, but wait a minute, maybe in 3 years or less, you could and now all of a sudden you got a decent discount on what this apartment was trading for 6, 12, 18 months ago. And now, 6 or 12, 18 months from now, you'll get that rate adjustment and then they'll marry each other together. So that's why I do agree, like understanding the marketplace and understanding value, I think, read market reports. And while market reports are great, the issue with market reports on closed is we all know that they're reporting on stuff that was put into contract 3-6, however many months ago. That was yesterday's market. It's not today's market. People and ask them what was going on, even in September, they would have felt drastically better than they do in October. I think there's been a quicker decline in the last, 30 days than there was before that. So it's so hard to pinpoint the market. It really comes down to what your use is and what your plans are.
Yeah, good advice. Brian, everybody wants to know how to lock in the lowest possible interest rate. So maybe you could walk through what people should think about in terms of that. How do you lock in happy with what you have? And how do you really avoid paying any penalties in order to be in a position where you might have to extend it?
Yeah, I think, it's a great question. We get it all day long, right? And I do have a crystal ball. You can't see it of my camera, but it doesn't work. I do. It's a nice ball. It's super heavy. But the reality is you can't predict what rates are going every day. There's so much external forces that impact interest rates, right? From more trading to certain Feds, certain members of the Fed speaking out individually on their opinions, to so many different aspects of, oil prices, to, Russia, Ukraine issues. So you can't predict perfect timing it. I always tell people, when you start in the beginning of the process, 99% of people shop for the mortgage before they even have a signed contract. My typical phone call is, hi, this is Brian Scott Cohen. And this next question is, what's your rate? I don't know, right? They just want to know what's your rate, what's your rate, what's your rate. And the rates aren't the same for everybody, right? Some people have one credit score, someone else has another credit score. Somebody could be buying a 4-family house versus a single family house. They all have different rates, right? It's not the same rate for everybody, rate for each property type. So with that said, number one, be proactive as a buyer. Proactive meaning that New York City timelines to close do take longer because of our collateral, right? Condos, co-ops, they're not all single family houses, where you need to get us paperwork, right? Stop fighting the paperwork, be proactive, get stuff done. That includes board packages for co-ops, condo right of first refusal. Be proactive on your paperwork. Things taking longer, be vocal. Tell your attorney, tell your real estate agent, hey, I really need to leave by this date. I need to close by this date. Let everybody know so there's open communication. One of the good things that we have here at Guaranteed Rate is if you start the lock a rate, you're starting at worst case scenario, right? If rates go up, you're protected from the upside. If they go down, we have options to float down their interest rate to drop their rate. So again, shopping in the beginning of the process, 99% of people before they have the contract, and you can lock, but know that rates change every single day. I always, tell people when they're comfortable is when they should lock.
Gary, Brian's got a crystal ball, said it doesn't work, but you're a lot of experience. You've seen the up and downs of market. You talked about what you saw over the last 30 days. But what are your thoughts in terms of what the market will look like in 6 months?
I mean, look, I think that the market's going to go through a period of adjustment over the balance of through the first quarter of next year. You know, we have midterm elections that are coming up soon. We do have the Fed determining what they're going to do with rates soon. And we have holidays and everything else coming along with that. So, you know, absent something that I don't see, have is actually the same one that Brian sent me. So mine doesn't work either. So he wanted us both to have broken crystal balls so we could always talk the same. You know, I think we're just in for a bumpy ride until people make the necessary adjustments in pricing and they going on with interest rates. But my advice always to people is, look, you're never going to be able to hit the market perfectly. There's going to be times when you're going to come out ahead. There's going to be some other times where maybe you're not going to come out ahead. But if you have a long enough horizon, most of these themselves out. So I think it's a matter of understanding, like, no one knows exactly what's going to take place. I think if you would poll everyone, they would say we're probably in for a bumpy ride. We got to get prices down enough to get people back in the market. And I think negotiability has been marketplace lately than it has been before. So I think that's the softening of the market that people need. And I've always felt, and I still will, that New York City in particular is a great place to live. And despite all the stuff that comes along with it at times, ultimately speaking, it's a place that people, you walk around the city right now, it's packed, it's busy, people are buzzing around, there's still activity. It's just an adjustment. And like I always joke around, we've all seen this movie before. We've all seen shocks to the system, and everyone just likes to go to the extreme bad case scenario. We can bounce around in the middle for a little bit of time. I think that I'm seeing deals come in on a daily basis. Is it at the velocity that our agents would like to see or Brian would like to see? Probably not. But I think we're also sort of caught in that vortex of 2021 was such a great. We're using that to guide every decision we make, where we need to go back maybe to 2019, give or take, and really start to analyze where the market is. It just feels really extreme right now. So I think in those moments, that's why it's going to take a little more time to sort of figure itself out.
Brian, you mentioned how that meeting in November potentially could see a rise in interest rates. So what effect do you think rising interest rates have on the buyer and on home prices?
Yeah, I mean, I think a lot of it is, again, back to the payment versus the rate. And, you know, a lot of people don't understand the cost of funds. Yes, your interest rates are up 100%. But you are seeing price decreases, not huge by any means at all. You're seeing small decreases and you're still demand, right? You're still seeing bidding wars. You're still seeing things move, but you're also seeing more cash in the market than I've seen in a long time. So we're seeing people take money out of maybe the market for some instability in the stock market, and they're taking out, you know, using line vehicles to purchase property, especially in New York City, to get some kind of stability, right? Like Gary said, rents are still very high and they're very much in demand. So we're seeing a lot of people and investors that are looking to still buy in New York. So I think the demand is definitely there. I don't see a shrinking demand. We're in, you know, one of the most amazing cities in the world where people want to be here. I mean, streets are buzzing. I live in the meatpacking district, and you know, it's busy, guys. Like it is are packed and people are out. And I think people want to be here. And I think there's still going to be strong demand despite rates rising. And I think, again, you got to talk to the professionals because you need to understand, you know, can you buy? What is it? Borrow money right now? And there's a lot of options with different loan types.
Gary, I'd love your thoughts on buying a fully renovated home versus something that needs a lot of work that you potentially could get at a discount. What's your outlook when people are thinking about buying?
Well, the first question I would ask is, how patient are you? You know, listen, I think there's obviously always a value to buying something that needs work because it's going to trade at a discount to something in perfect condition. So it really depends upon your personal circumstances. Again, you know, listen, with the supply chain issues that still exist, and for anyone to think that they've been solved, that, you know, good for them, maybe their circumstances are overall. You speak to contractors, you speak to anyone, there's shortages of labor There's shortages in getting materials. There's time delays in getting materials. So while in many instances, it's great to buy a home that needs to be renovated, envision how you want to live in the space versus how the space presents itself at its current circumstances. And in the end, you're probably going to end up being happier because you put your, your fingerprint on it, and it exudes who you are. But if all of a sudden it's twice as long as you anticipated, if costs continue to rise, are you ready to deal with those anxieties? You're ready to deal with those issues. And, there's plenty of people that are, they understand that like this is a somewhat of a risk. I wouldn't say an enormous risk, but now than it's been. I'm sure anyone on this, seminar that's been trying to get any work done of any sort has run into delays. It could be a day, it could be a week, it could be 6 months. I was speaking to someone, that has a home out here, and he's been replacing his window. Supposed to be replaced by May 1st, and now they're not coming in until December 1st.
Oh, wow.
So, these are things that no one can control, right? The contractors can't control it. And listen, contractors are definitely having problems finding good, talented work that comes up on a consistent. So you got to be able to deal with those circumstances and understand. You also need to speak to your building that you're contemplating purchasing, and like, what are the work rules here? Just get a firm understanding of that. I just think it's eyes wide open. I don't think one or the other is better. It's wired as a person.
Yeah, thank you, Gary. We're going to get into financing options and areas that offer the best value in a minute, but we're going to open it up to some questions. I know we had a pretty large group join us since I first said at the beginning, you can ask questions in the Q&A and the chat. So we'll take a couple of them now. I guess this one could be really for either one of you. History, I guess this person wants to look at. Can you talk about the last time interest rates increased this fast and what happened to pricing during that last cycle? Anybody want to take that one?
Yeah, I can try and address it. And then Gary, in my 19 years of doing it, I haven't seen it, is the truth. I've never interest rates double in this short a time frame, or double ever, is the truth. We've seen it come down. We've seen it come down in not half, but in large percentages. We've seen decreases, but I've never been part of an increase like we're seeing.
Yeah, me neither. And I think it's somewhat unprecedented for anyone that's sort of been around for the last 20 or so years. The natural reaction is if it costs more money to buy and your payments are going up and there's recession/inflation, I think that it's going to have some impact on pricing. But, once again, you always have to say to yourself, like, not everything's created equal. There are just certain properties and certain locations that are always going to command a premium, regardless of what the circumstances are, because there might not be that many. Then the stuff that's more of a commodity that's out there all the time, those are the ones that are going to have more price adjustments. So, like Brian was saying also, in terms of like the first time home buyer, they're going to start measuring up what does it cost to rent versus what does it cost to buy, and they're going to have to. And I think it's really tough when you see rates, rise as much as they've been. I'm like, Brian and I certainly aren't the smartest guys in the room. And I watch a lot of shows where these, very astute, smart financial people come on, and a lot of them are like banging the drum that the Fed has got to stop what they're doing. They're trying to undo what they did about giving free money for so long, but they're doing it in a way that's actually hurting, not helping. So they feel like they've already done what they should do, and any further rate increases, which could have even further impacts on the marketplace. So I think when you start to hear all of those things, I think sometimes you just got to take a deep breath and see how things go and figure it out, because I don't know that we can accurately assess where. Listen, if there's a significant change in the midterm elections, maybe there will be a change in sentiment that will make things go quicker in the other direction, but it's hard to say right today.
So here's another question from a gentleman, Stephen. I'll kind of broader, but in this case, he's retired, he has assets, he doesn't have a lot of cash, he's not currently working. So can he still be in a position to get a mortgage?
Possibly is the answer. I mean, there's so many different, we at Guaranteed Rate have over 150 different loan programs, from bank statement programs to asset only loans to, a lot, right? So Stephen's his name, Stephen. So the answer is it's definitely possible. We need to know But we do have programs for people that have assets, are heavy in assets and not specifically income. It's called an asset only program where we use a formula based on your assets to derive income. So yes, is the answer.
Many different variables. People could probably ask different questions on many different states, but again, I guess that's where you come in to try to help them go through the numbers and their personal situations.
Absolutely.
So let's go into options that are available between financing a co-op versus a condo versus a new construction condo versus a single family house, multifamily house in New York City. So Brian, maybe you can just give an overview of what the differences are those properties.
Yeah, I think when you're dealing with, condos, townhouses, multifamily, you're kind of I think condos and townhouses, you're probably in the same bucket where you have, I would say, more expansive lending, not restricted by a co-op board rules or requirements, right? So what that means is you can do lower down payments. It means, on multifamily, you can use future rental income to help qualify a buyer. Typical co-ops want 20% or more down. Some are 50%. You could get something called a sponsor co-op where you can put less down. Typically 10% is usually the minimum we see on co-ops. But financing usually starts the same when we pre-approve a client. We don't typically know what specific property, right? They want to know how much does it cost to borrow money? Can they borrow money? And of course, what's my rate, right? So when we talk to clients, we don't know if it's a condo or a co-op. So we approve them in general for a max loan amount they can borrow. And if it becomes a multifamily, we then tweak it using some of the rental income and upside potential of the property. So hopefully that helps.
Yeah, thank you. So Gary, Corcoran has the region. But for you, what neighborhoods and property types offer buyers the best value in New York City?
I mean, like we discussed earlier, obviously the co-op versus a condo is clearly going to be more of a value-oriented play. Building, fully amenitized building versus a non-amenitized building, proximity to transportation. There's a variety of different factors that are ultimately going to determine what's value. Listen, I think overall the city has performed extraordinarily. Current circumstances that we're in right now, most neighborhoods have seen, very nice appreciation over the course of time. There's a lot of infrastructure changes that have been made. What's going on with Grand Central and the Long Island Railroad or the Second Avenue subway. You see you see all these different things that are going on. So areas that once, let's say, were transportation challenged, let's call them, are no longer as challenged as they once were. But obviously transportation plays a big part in pricing and convenience and everything along those lines. So transit isn't necessarily a key to you. Like, let's say if you're on the Upper East Side, as you keep on going further east, you're going to get some better value than when you're closer to a transportation line. So there's so many factors that really go into that. And then what's important to you? Like, in today's day and age, with everything changing about work, do I need to get to work every single day? Do I only need to get to work a couple of days a week? So like if commuting time, which used to be such a major decision-making, that shifted a lot because people are working from home. So if you can sort of move to a neighborhood that's quote unquote emerging, that isn't as, fully, materialized price-wise as other neighborhoods, those are areas as well. And that's why I think it's really important to sit down with and really give them an understanding of what's important to you and let them bring up all the options that exist. Because once again, I had a really good friend of mine who he's buying an apartment for his son. And my first point was, please don't buy a co-op. I just don't think it's really, given what I think and what you're doing, I think ultimately he might not live there that long. And you might want to keep it as an investment and renting it, et cetera, et cetera. What did he end up doing? He bought a co-op. I guess my advice was great. And his only point was like, look, it's just cheaper. And it gives me what I want. The payment's great. It's kind of resonates for rent and I'm not worrying about it. And then like he's another person that's like, look, I know the market's shifting and I understand that it might go down X% over the next X amount of time, but ultimately it's a perfect apartment for us. And this is where he's going to be happy. and I could always refinance this out later and make it make sense. So to me, this made sense. So I think that dynamic is ultimately going to play in everyone's mind. It ultimately speaks to what's important to you.
Thank you. Brian, let's touch into a little bit more about financing options and what financing options are available for different types of properties, whether it be Brooklyn, Queens, Manhattan, Staten Island, and or the Bronx, particularly at different price points, jumbo loans. So maybe if you could just give a little input on that.
Yeah, I mean, I think, right now in the market compared to, the last downturn, besides COVID, everyone talks about, oh, why is this different than 2000? Seems like there's a lot of articles about, how this is different than 2008. And what we're seeing is there's a lot of credit out there readily available, meaning that we're not seeing cuts on jumbo loans, meaning that there's jumbo available now where you can put down 10% on a jumbo loan. You can do 20% down and still obtain interest-only financing or adjustable rates. You don't, everyone always thinks that you need 20% or you need more than 20%. And at times like the opportunity to buy comes in where you can do a lower down payment. We have 5% down programs to loans of $1 million. We have 10% down to $3 million, right? So there's a lot of there for people who think, I don't have the money to buy. Well, maybe you do have the money to buy, right? So I think the jumbo market right now it's moving, right? It's not, there's no credit restrictions. We're not asking for larger down payments to qualify. We have so many different investors and partners that we work with that each one has different niches or more flexibility if you need flexibility. The rates are not obviously all the same, but the more qualified, the larger down payment, the higher credit score, be a little bit lower. But again, it's not permanent. As you own a home and start paying your principal every month, you're building automatic equity. And over time, you can refinance into different products, I think, that become more available. But a lot of credit out there. There's definitely get loans. We're not seeing any issues or we're not seeing a higher rate of decline because of interest rates. We're not seeing any of that at all at this time.
Gary, back to you. What do you think will be different about buying this fall and winter?
I just think uncertainty. I think that's probably the biggest thing that's driving people right now is like, where are prices going? Where's the market going? Where's the economy going? Where's the stock market going? Where's the political winds? Look at so many different factors that I think weigh heavily on everyone's minds that it's hard to really not think about all these things because you can't turn on the TV, you can't look at your phone, you can't help but see what's going on and hear what's going on. Those things are creating sort of an anxious buying and selling population that's been different. COVID was like a shock to the system, but no one looked at it as this fundamental issue with the marketplace. It was a pandemic, something none of us have experienced. So, but you knew that, at least you hoped that would, subside itself sooner than later. And thank God it got to the point where it's controllable. But right now, I just think there's so much uncertainty that's going on that I think it makes it hard for people to make good, sound decisions. But if you could sort of weed through that and really hone in and focus on what's important to you, there's opportunities. There's always an opportunity in the marketplace if you're willing to look for it. It just might not line up exactly the way you thought it was going to be.
Brian, before you said about putting down 5%, which is kind of amazing. I'm sure there's different scenarios and different situations, of course. But what options, particularly for first-time home buyers and others, are there really for people that want to put down less than 20% for an apartment?
Yeah, there's a lot of options, and we're seeing it more now than ever. I know, I did mention the 5% down program. There's always been government-backed loans, VA loans. If you are buying a house or a condo building that's VA, 100% financing with no mortgage insurance, which is an amazing opportunity out there for our vets. On FHA, it's 3.5% down payments, and every year they raise what we call the conforming loan limits. So and higher on the amounts that you can borrow with lower down payments. And same thing, same availability on multifamily homes. So really, it's just co-ops that require more than, call it the 5% compared to the other products. for down payment. The higher price you go, the more we want to see down. But a lot of products out there from 0 down to, a lot more.
We have a lot more questions coming in here. I have one more question for Brian, but Gary, let me throw that seems to be coming through from multiple people. And really to sum it up, is there more negotiation going on in terms of pricing?
Yeah,
whether for new development or for, secondary?
Absolutely. I think you're seeing more negotiations now than you've seen, recently. I think that the buying population sort of gets the sense of where the market is. They see what's going on the interest rates. They understand what's happening out there. So there's no doubt that people are coming in from, anywhere from 7 to probably 15%, depending on circumstances, off. And I think you're getting ultimately whatever the ultimate deal is. It's certainly not what the buyer is putting out as their first offer, but you're definitely seeing a fair amount of negotiation. Look, everyone understands what their asset is worth. And especially if you're in the new development world and you have a fair amount of inventory to move, the daily, the weekly, the monthly, the yearly, there's so many, deals that happen over that maybe the front loaded stuff was more expensive, or, you got a higher price than projected, and now things are slowing down. So an owner wants to, sort of leverage his or her current circumstances and do some deals here and there. But listen, it's always, people need to be realistic. Sometimes people think they can just make these crazy, crazy offers and that people are just going to die to make them happen. The answer is they're not. It has to make sense for both sides. And I think it's important to get current data, right? See what is on the market now. See what went into contract recently. Get a true sense of what's going on, and then come up with a strategy that you feel comfortable with. You could just put yourself in the situation and say, this is what I can afford. This is what I'm willing to pay. I have apartments being offered for, but it's been on the market for X amount of time. But put in a reasonable offer. You don't want to put in an offer where you have very little room to go and the person who receives that offer doesn't feel like you're being genuine, because in the end, you might lose exactly what you want, There's definitely negotiability. I just think people always have the perception and idea it's more than they think. So they get disappointed when they get what would be perceived to be a very nice reduction in price, but to them, it's just simply not sufficient enough. But that's because it just doesn't make sense for them. And just like every buyer has a sort of plan in their head, every seller has a plan in their head. So I think you have to understand, I always joke around, but the best negotiation is when both sides walk away a little bit unhappy, right? As long as you didn't, probably a good deal.
Interesting. Yeah. Thank you so much for sharing that.
Yeah, of course.
Brian, you touched on it a little bit, answering one of the questions from one of our audience members, but I think there's a little bit more information that you could share in terms of what lenders require of buyers. So for example, employment history, credit score, cash reserves after your closing, debt ratio. And in addition to what they're looking for, how long does that process typically take? What should people anticipate?
And what we require is going to also depend on purchase price, property type, loan amount. But in general, good credit scores these days is really considered 780 plus. Some lenders we work with are 800 and above for credit. Debt ratio, same thing. When we pre-approve a client, we're looking at debt ratio kind of maxing out around 43%. But if you're a buyer and you're looking at a co-op, you need to be between 25 and 30% on the high end. That will dictate what you need to qualify. And us as a lender, depending on the loan size, we need reserves anywhere between 2 months and I'd say 24 months of mortgage payments and kind of post-closing assets is super important.
I feel like people don't think about that. How much money you have left over after you buy the house is important. And, really what you're saying is that big difference between a couple of months and a couple of years worth of reserves, probably based on every person's individual situation. I see that there's a lot more questions that came in that we're not going to get to, but what I can tell you is both Brian and Gary would love to hear from you. They're certainly available, and I'm sure Gary could put you in touch with some of Corcoran's top brokers, depending on the and then the other is that this is going to be fully recorded and available on brownstoner.com, and we will email you both the links to them as well as to the video. So I really just want to thank both Brian and Gary for their night, as well as the sponsorship from GR Affinity and Corcoran. And I want to also give a shout out to Corcoran. I told Gary before we got started, I just bought a home and sold a home using Corcoran. And I have to tell you, both brokers were phenomenal to work with, and it was a pleasure. So a little testimonial there.
We appreciate it, of course.
That's our pleasure. All right. Well, thank you both. And again, thank you to everyone watching. And we hope you learned something new today.
Thanks, guys. We appreciate it.